Okay, I'm going to try and explain volatility index and what it actually means. The VIX, this is the VIX is a theoretical number, and it's a measurement of the the puts and the calls in on the CBE, the CBOE, and it's a calculation. It's a theoretical calculation, and what that's quite often called is the fear index, but it is the volatility index. But it's quite often called the fear index. But in actual fact, it's a bit of a misnomer, because what this is predicting, it's a 30 days. They use the close-in options, 30-day expiry. And it's a calculation of where they think the market is going to be in the future. So the volatility. So currently the VIX right now is at 14. So what the market is saying is that, let me just look at the calculation. It's a huge. What they mean is that at 14 here, that means that there's a 68% chance, one standard deviation, that the market is going to be up or down 14% over the next year. So even though it's the close-in options, the puts and calls for the SPY, I'm not sure if I said that. So it's the puts and the calls for the SPY, and there's a formula for it, and they calculate it. And so they're saying that within the year, there's a chance that this market is going to be 68% of the time, it will be 14% higher or lower. That's the VIX. So it's a volatility index. So, and you'll see that the VIX, this is the lows for it, is like around 9. No volatility whatsoever. And you can see here this thing spiked to to 50%, that there was the market was predicting that over the next year the market would be up or down 50%. Now that's obviously skewed. That's not a practical type of indicator, but that's why it's called the fear indicator, which in effect is a bit of a misnomer, because this is predicting 15%, 14% up or down, not necessarily down. But where you get the big spikes is when the market is coming off sharply. And so typically when you get these big spikes and this huge volatility, the market is thinking that the market is going to, the investor, like the broad market investors, institutions, are thinking that the SPY is going to drop. It's going to go down. And so that's why it's called the fear index. As the higher it gets, the more likely the market is going to go down. So you look at the VIX and you're watching to see if it spikes in above 15 or 20, really, but 15 or 20, then you start getting fear coming into the market, and you start to look then to trade TVIX or UVXY, the bearish ETFs. But it's a measure of volatility based on the options for the SPY, and it's a tool that people use to predict which way the market is going to go. So it sort of never gets down below 10. 10 is very low, and there's no volatility in the marketplace at that point. And that's usually a sign that it's a topping sign quite often. But you can see here, the market just kept going up and up and up and up. higher and higher. And so, never topped out until you got this big spike down. This is that 10-12% correction that we had in the market. Huge. And the market then was fearful that the market was going to drop 50%. Of course, it never did. It only came down 10. And so that's the fear index of it. And so any of these pops, if you matched it with a move on the SPY, you would see that these were probably big drops. And this here, where it's in this level here, this is just a no volatility uptrending market and very strong markets.